Hello everyone, this is Grace here. In this video, we will be discussing problems related to differential costing and marginal costing. What are the various operations or decisions which the management takes in order to decide which product renders good profit to the organization. So now illustration for elimination of product. So in our last video, we discussed about that level of planning, level of activity planning, then related to other purchasing and or leasing problems were solved. So now next is elimination of product. So in this example or in this illustration, when we are solving it, the illustration asks a question whether you are going to eliminate the product or you're going to continue the production of the product. So let us get into the product. So a company manufactures three products A, B and C. There is a common process and the sales of one product does not affect the price or volume of sale of another. The company's budgeted profit and loss account for 2015 has been as under. So sales, they have given the total sales. They have given for A, B and C the sales. Then they have given us production cost. So under production cost, they have classified as variable and fixed cost. So your variable and fixed is calculated and deducted under your product to find out your factory cost. Then selling cost, which gives you your selling cost. Under selling cost, variable cost and fixed cost is deducted to find out what is your it is calculated to find out here where your production cost or selling cost, which has both variable as well as fixed, is added up. So that would be deducted from the sales to find out the profit. So that calculation is shown here total for product A, for product B and C. So on the basis of the above, the board had almost decided to eliminate product C, on which a loss was budgeted. So on the basis of this, if you look into this, there is for profit. If you look into the profit, A, B as profit. When you look into C, it is having a loss of 900. So on the basis of the above, board had almost decided to eliminate a product C, on which a loss was budgeted. Meanwhile, they have sought your opinion as the company's cost accountant. What would be your advice? So now, if you look into this cost sheet, what they have already prepared, looking into the profit which is got, you will decide that it is better to eliminate product C and start manufacturing or concentrating on product A and B. But if you are a cost accountant, you need to analyze the data and find out which product to be eliminated. So now how are we going to analyze this data is, here with sales they have minused all the costs together. They have not differentiated what is your fixed cost and variable cost, and it is not, the cost sheet is not prepared accordingly. So here we need to classify what is fixed and what is the variable cost. So according to this marginal costing, it clearly states that fixed and variable should be clearly differentiated so that the calculation or so that the management can take good decisions. So now we are going to classify it. So when we classify it, sales, as per the question what is given, which is for A, which is 45,000, for B 2,25,000, for C it is 30,000. So let us take into consideration for A 45,000, B 2,25,000, for C 30,000. So the total will give up to 3 lakh. Next, with that we will minus variable cost. So sales minus variable cost will give you your contribution. So from the contribution we will minus the fixed cost. So now let us minus our variable cost. So your variable cost is for A is 24,000, and when you come under your selling cost, your variable cost is 8,100. So 24,000 plus 8,100, which will give you 32,100. So from 45,000 you will minus your total variable cost 32,100, which will give you your contribution 12,900. So again for the B, we have taken sales 2,25,000. To that we will minus variable cost to find out the contribution. So what are the variable cost is? For B, the variable cost under production or factory cost is 1,44,000. Then when we come to selling cost, the variable cost is 8,100. So 1,44,000 plus 8,100, which will give you which will give you 1,12,100. So 2,25,000 minus 1,12,100 will give you your contribution 72,900. Next, again when we discuss about C, which has sales 30,000, then factory cost or production cost related to variable is 12,000 plus under selling cost the variable cost is 7,800. So 12,000 plus 7,800, which will give you 19,800. So the total sales 30,000 minus total variable cost, which is 19,800, will give you 10,200 as your contribution. So in the same way, when we add up all A, B, C, it will give you your total. So when we add up the total variable cost under production sector, it will give up to 1,80,000, that is 24,000 plus 1,44,000 plus 12,000 will give you 1,80,000. The same way, selling cost under variable classification, which is 81,000 plus 8,000, I'm sorry, 8,100 plus 8,100 for B, and for C 7,800 will give you 24,000. So in the same way the calculation is done for your total side. So after we get a contribution, we will minus our fixed cost. So your fixed cost as per the question is, for product under production sector, fixed cost for A is 3,000, and for B it is 48,000, and for C it is 9,000. So let us account it. So under production cost, for A it is 3,000, for B 48,000, for C it is 9,000. So the total when we add up it is 60,000. Next, production cost under selling sector. So under selling section is, I'm sorry, fixed cost under the selling section is uh, which is 6,000, 2,100 and 1,800. 6,000 is the total. So 2,100, 1,800 and 2,100 for three products. So let us consider that selling cost 2,100 for A, for B 1,800, for C 2,100. So the total of it will arrive to 6,000. So this is your fixed cost under your section, production section and selling section. So when we add up your total fixed cost, for A you will be getting 5,100, for B 49,800, for C you will be getting 11,100. So now we have got a fixed cost. From a total contribution we will minus fixed cost to know our profit. So as per the calculation which is done by the manufacturing or industry, they have got the same answer. Profit for A it is 7,800, for B 23,100, for C it is 900 as a loss. So the total profit what the company is earning is 30,000. So you can ask me a question. The calculation which is shown in the question is similar to the calculation which is done in the solution. So what is the difference that we have found it? It is better to look into the question and find out that there is loss in C, and we can ignore the section. But you being the cost accountant, you need to analyze the data. So when you analyze the data, always you need to look into the contribution sector. As I've already discussed, variable cost is a cost which keeps on fluctuating irrespective of how many ever goods you produce or what is the production. Based on the production, it keeps on varying. So that is why it is called as variable cost. So when a variable cost is calculated and it is being deducted from the sales, you get your contribution. So that contribution will be the profit, exactly what you're going to earn. From the contribution, you can decide which product to eliminate and which product to sustain in the industry. So fixed cost is a cost which is always fixed in your organization or industry, irrespective of whatever changes you do. The cost for it will never change whether you produce more units or whether you increase your sales. There's nothing is going to change your fixed cost. For example, you are having a warehouse where you provide rent for the warehouse of 3,000 rupees. So this warehouse rent will always be 3,000 at least for a year. So 2 years. So how many ever production or how many ever units you store in that particular warehouse or that particular room, the rent for it will never change. So fixed cost will always remain change. So as being a cost accountant, what would you suggest is, it is better to keep product C, because if you look into the contribution, that is after you minus your variable cost, the contribution what you get is 10,200. So is it giving you a loss? No, it is a profit. So 10,200. So if you keep the product C in future, whether you're increasing the units or if any changes is done to product C, it will give you a profit, or contribution will be in a positive value and positive amount. So as fixed cost remains same, it will always remain to the cost what is incurred. It will always be 11,100 for product C. But imagine if the sales is increased for product C, and if the variable cost is, if sales is increased or variable cost is decreased or increased, the contribution, there is chance of increase in the contribution. So always a cost accountant, when preparing the cost sheet, you need to concentrate on the contribution and decide and come to a conclusion, because fixed cost will always remain fixed. It will not harm the business, or it will not harm the industrial or industries in judging up the in selection of the product. So as I would like to conclude from the above, it is clear that product C is contributing rupees 10,200 towards the profit of the company. If product C is eliminated, the profit of the company will be reduced to 10,200. So there is chance where you will be getting only 19,800. Hence it is not advisable to eliminate product C. So how did you get 19,800? Is 30,000 of the total profit minus the contribution which is going out, which is 10,200. So it is advisable not to eliminate product C. So let us get into the next problem, illustration 5. So under this problem, utilization of resources for improvement of profitability. So how are you going to utilize the resources for improving your profitability? So let us get into the solution. A Limited manufactures 3 products, and the cost particulars for a year as follows. So particular X, Y, Z. Sales is given, material cost, labor cost, variable overheads, fixed overheads for X, Y, and Z is given. The company imports one of the raw material which is used in manufacture of all the products. The consumption of material is as follows. So where X utilizes 2000 kg, Y utilizes 5000 kg, Z utilizes 3000 kg for produce raw materials or materials are used. There is a restriction in import of the material. So the management is planning to close down one line of product and utilize the material for the other two lines to improve the profitability. As the secretary of the company, prepare the report for the closure of one line of for the improving the profitability. So as this company is engaged in producing 3 products, as there is a restriction in imports, it can be any restriction which is done in order to reduce the imports. So the material supply to this industry will be restricted. So it is better to close one section of the product or one product in order to, and utilize the raw materials which has been imported of that product to the product which gives a good return or gives profit. So as a cost accountant or as a company secretary, how are you going to decide which product you're going to eliminate and use that raw materials to for the other products in order to earn profit is your work. So now let us get into preparation of the cost sheet. So under the preparation of cost sheet, report for the closure of one line of product. Which line of product are you going to close? So first your sales, next you'll minus your variable cost to find out your contribution. From that you'll minus your fixed cost, and you will rank according to it. So here they asked you to rank. So as it is clearly mentioned, utilization of resources for improvement of profitability. So in this you will rank which product is benefiting you, and based on the ranking you will eliminate the product which is not giving you good returns. So now we will take into consideration sales. So there are 3 products. So sales for X is 2 lakh, for Y 4 lakh, for Z it is 2 lakh 50,000. So with that we will minus our variable overheads. So under your variable overheads uh, they have given under your sales they have given you material cost and labor cost. Then they have given your variable overheads. So material cost and labor cost are nothing but your factory expenses. So let us minus your material cost and labor cost with your sales. So now your sales is 2 lakh, 4 lakh and 2 lakh 50,000. So less your variable cost. Your material and labor are also your variable cost, because the number of production units you increase, the materials and labor charges also increases. So the more units, raw materials you import or you acquire from the supplier, he will based on the quantity he will charge you the price for the raw materials. So it is also coming under your variable cost. So now we will take material and material for X 1 lakh, for Y 1 lakh 50,000, for Z 1 lakh 25,000. So let us take material 1 lakh, 1 lakh 50,000, and for Z 1 lakh 25,000. Next is our labor, which is 30,000, 50,000 and 40,000. So labor 30, 50 and 40,000. So this will give up your total, this will give up your variable cost for material and labor. So now we will be taking your variable overheads, which is given here, which is so material cost and labor cost will come under variable expenses, which will give your major cost, that is nothing but the prime cost what you incur. Now we will add up your variable overheads. For X it is 10,000, for Y 20,000, for Z it is 25,000. So now total variable cost overheads for X 10,000, for Y 20,000, for Z 25,000. So now we have calculated all your variable costs for all the three products. So the total variable cost is 1,40,000 for X, for Y it is 2,20,000, for Z it is 1,90,000. So now your sales minus your total variable cost will give you your contribution, which is 60,000, 1,80,000 for Y, and for Z it is 60,000. So after this you need to check whether you have got any fixed overheads. So now you can minus your fixed overheads with this, or you can rank your product directly, because we will always concentrate on the contribution. So your contribution will tell you what is the which product is better to be choose before minusing your fixed cost. So you can also calculate by minusing your fixed cost, the ranking will be the similar. So now with contribution, which we have got, we will divide the units. So what is the units? 2,000, 5,000 and 3,000. So now for X we have got 60,000 as contribution, and the number of units which has been imported, that is raw materials imported for that X product, is 2,000. So we will find out what is the contribution per unit or per kg of raw materials. So 60,000 divided by 20,000, 2,000 will give you 30. Then for Y, it is 1,80,000, and the number of units which has been imported for Y is 5,000. So 1,80,000 divided by 5,000 will give you 36. Next you have for Z, it is the total contribution what you have got is 60,000. So with 60,000 you will divide the number of units for Z, which is 3,000. So 60,000 divided by 3,000, which will give you 20. So 30 for X, for Y it is 36, for Z it is 20. So looking into the contribution what you're getting, for Y you get more contribution, so you will rank it as 1. Then we come to X, which is giving us more contribution, that is 30. So we will rank it as 2. Then comes the last contribution, which is least compared to the two products, which is Z, which gives us the contribution per kg, which is 20. So Y will stand in the first place, X in the second place, Z in the third place. So looking into this ranking, you can judge that product Z gives the lowest contribution per kg of imported materials. So it is better to use the raw materials used for product Z to produce more of product Y, so the profitability of the company increases. So production of Z will be discontinued, and that 3,000 kgs or 3,000 raw materials which is mentioned in the question, which has been imported for product Z, will be used in manufacturing product Y. So the profitability increases in the company. So the next problem what we are going to discuss is illustration 6, acceptance or rejection of an offer. So under this, a chair manufacturer limited presents the following information for the past year. Particulars and amount is given.
for which material cost, labor cost, fixed overhead, variable overhead, units produced, selling price is also given in the problem. So then it is stated that the available capacity of production is to 20,000 units per year. The firm has an offer for the purchase of 5,000 shares at a price of rupees 40 per unit. It is expected that by accepting this offer, there will be reduction of rupees 1 per unit in material cost. The fixed overhead will increase by rupees 35,000 and overall efficiency will drop by 2% on all production. Draft a report to the management giving your recommendation as to whether or not the offer should be accepted. So whenever you're solving this problem, please make sure that you are the cost accountant or accountant of the company or a company secretary who is giving advice to the management. So this is the management over the production sectors, so which product to produce. So most of the work which is being carried out by the managers to make decisions on these aspects. So as a cost accountant or as a company secretary, what are you going to suggest it to your management? So now, as they have given material cost, labor, fixed overheads in units produced and selling price per unit, they have asked the available capacity of production is 20,000 units per year. So they produce 20,000 for 1 year, 20,000 units for 1 year. The firm has got an offer to purchase of 5,000 shares at a price of rupees 40 per unit. So, as the firm has an offer for the purchase of 5,000 shares at a price of rupees 40 per unit, it is expected that when you accept this offer to produce 5,000 extra shares at this price, it is expected that by accepting this, there will be reduction of rupees 1 per unit in the material cost. So the analyst have already told that if you accept this order, there will be 1 rupee less in the material cost. The fixed overhead will increase to 35,000. So keep in mind, the fixed overhead will increase to 35,000 and the overall efficiency will drop by 2%. So how is this going to be done? Let us look into the draft of the report, where we are going to calculate and recommend the management. So the draft report is particulars, products, which existing products is as per the question is the units. So the capacity of the production is 20,000 units per year, but the actual production units produced is 12,000 units. So if 12,000 units are produced, this will be the cost which is to be incurred, and you will whether you're getting profit or loss will be known by the calculation. But along with this 12,000 units, if a new offer which has come to produce 5,000 shares, or it is units, 5,000 units extra, these are the causes which are going to incur. So now we'll have two classifications. One classification will be for 12,000 units, and if the offer is accepted, then 12,000 plus 5,000, as the offer is for 5,000 units, 12,000 plus 5,000 will give you 17,000 units. So now let us calculate. So we need to consider the total cost per unit for both the units, because there is involvement of cost per unit everywhere, where selling prices for cost per unit, and there is adjustment stating there will be reduction in 1 rupee per unit. So you need to have the column for per cost per unit. So as per the cost sheet, first is sales. So let us take into consideration sales. So in this problem, they have given selling prices rupees 50 per unit. So as the selling price is rupees 50 per unit, the number of units produced is 12,000 units for the first, that is initial production is 12,000. So 12,000 into rupees 50 will give you the total sales, which is 6 lakhs. So the cost per unit is rupees 50. Then it is mentioned if it is increased, that is if you accept the order of 5,000 shares at a price of rupees 40 per unit. So as we have got 6 lakh for 12,000 units, where the cost per unit is 50, 50. In the same way, the products, when the proposal is accepted, which is increased by 5,000 to 7 plus, so 12,000 units plus 5,000, you have got 17,000 units. So how are we going to calculate the cost for it? We, as per the question which is stated here, it is stated the firm has an offer to purchase 5,000 shares at chairs or units at a price of rupees 40 per unit. So the selling price is rupees 40 per unit. That 40 per unit is only for 5,000 chairs. So you can't take that 40 for multiplying with 17,000 units to find out the sales. So before the proposal, what was the number of units? It is 12,000 units. What was the selling price? 50 rupees. So how much are you getting? 6 lakh. So for 5,000 units, if the offer is accepted, the cost is rupees 40 per unit. So for 12,000 units, if it is 50, then 12,000 into 50, we will get 6 lakh. Now, when we are adding up the offer 5,000, so the total number of units is 17,000. For 2,000 units, for 12,000 units, if it is rupees 50, 12,000 into 50, which will give us 6,000. Then for 5,000 units, 5,000 into 40, which will give us 2 lakh. So for 12,000 into 50, we will be getting 6 lakh. For 5,000, the cost, if the offer is accepted, it is 5,000 units, and the cost is, and selling price is 40 per unit. So 5,000 into 40 will give you 2 lakh. So 6 lakh for 12,000 units, and for 5,000 units, which is 2 lakh. So 6 plus 2, which would give us 8 lakh. 6 lakh plus 2 lakh, which would give us 8 lakh. So now, as we have got 8 lakh here, 8 lakh divided by 17,000 units, we will get our cost per unit, so which is 47.06. So with this, we will minus all our variable cost, that is a material cost, labor cost, and variable overheads. So material cost is 1,20,000 and labor cost is 2,40,000 and variable overheads is 60,000. So we will take 1,20,000, 2,40,000 and 60,000. So the total variable cost is 4,20,000. So now we will find out the cost per unit. So for 1,20,000 divided by 12,000 will give you 10. 2,40,000 divided by 12,000 units will give you 20. 60,000 divided by 12,000 will give you 5. The same way 4,20,000 divided by 4,20,000 divided by 12,000 units will give you 35. So now we have done with the variable cost for product 12,000 units. So next for 70,000 units, what is the variable cost we will be calculating? So the cost per unit will remain will remain same. As per the units, the total variable cost will change. So at the end of the problem, you will also learn the other thing, difference between the variable and fixed overhead, how it works. So now the cost of variable cost is found out, the cost per unit is also found because it is given in the question. So when 17,000 units are produced, how are you going to find out your variable cost? So as the material cost is cost per unit for material cost is 10, and as per the adjustment, if the proposal is accepted, if the proposal is accepted, uh, this offer, there will be reduction in rupees 1 per unit in material cost. So your material cost is 1,20,000. The cost per unit is rupees 10. As you have told, if 5,000 units is extra is produced, then 1 rupee will be less. So out of 10 minus 1, which will give you 9. So 9,000 into 17,000. So 17,000 units into 9 will give you 1,53,000. So you have got your material cost for products for 17,000 units are produced. Next, your labor cost. Look into the question. Have you given any information regarding labor? No. So your labor will remain same. So what is the cost per unit for labor? 20. So now for 12,000 units it's 20. Then but the labor cost for 17,000 units is changed from 20 to 20.41. So how is this change occurred is, if you look into the question, material cost as an adjustment where 1 rupee is reduced, then they have given fixed overhead also 35,000 has been increased, and the overall efficiency will drop by 2% on all productions. So where will this calculation be shown? So what they are stating here is the overall efficiency, in the sense the profitability of the firm will reduce by 2%. So when will the profitability of the firm reduce? When the cost price increases. So it is clearly stated overall efficiency will drop by 2% on all productions. So material already has an adjustment. So what is the other production sector where production expenses are incurred is under labor. So when the labor is increased by 2%, that is, if it is increased by 2%, then the overall efficiency will drop by 2%. Yes, so labor is nothing but a cost. So when the cost increases, the overall efficiency decreases. So when you increase the cost by 2% in your labor, the overall efficiency will reduce. That is what is stated here, will reduce by 2%. So now let us get into the calculation. So here for 12,000 units, the labor cost is 20. So 20 into 2%, which will give you 0.4. So 20 plus 0.4 will give you 20.4. So 20.41 into 17,000 units will give you 3,46,970. So now, so you have got 20.4 by 2% increase in your production cost, where we have increase in your variable cost. So 20.4 into 17,000 will give us 3,46,800. So next we have considered material labor cost. Next we will be taking into consideration variable overheads. So under variable overheads, as there are no changes in the question, the variable overhead which is there in the question is 60,000. So we have taken 60,000 here. So the cost per unit is 5, so it will remain 5. So 5 into 17,000 would give us 85,000. So next we will add up, we will minus sales minus total variable cost. So with the sales as it is A, we'll add up all your total variable overheads. So where we will get for 12,000 units 4,20,000, and the cost per unit for 12,000 units is rupees 35, and for 17,000 units the total variable overheads is 5,84,800. Then the cost per unit is 34.40 per unit. So now with this, as we have got your total variable overheads, next we will find out our contribution. So sales minus variable cost, you will be getting your contribution. Sales is 6 lakh under 12,000 units minus total variable, which is 4,20,000. You will be getting contribution 1,80,000. In the same way, 50 minus 35 cost per unit under 12,000, you will be getting 15 rupees. Then for product 17,000 units, sales 8 lakh minus 5,84,800, you will be getting 2,15,200 as contribution, and the total cost per unit for 70,000 units under sales is 47.06 minus the variable overhead per unit is 34.40, which will give us 12.66. So now as we have got a contribution, next step is we'll minus our fixed cost. So under fixed cost, what is given here is 1,20,000, which is for 12,000 units. And they've stated in the question, the fixed overhead will increase by 35,000. So now, so what is your fixed overhead, which you have already looked into the question, 1,20,000. It will increase by 35,000. So 1,20,000 plus 35, which will give you 1,55,000. So how did you get your cost per unit for your fixed overhead is 1,20,000 divided by 12,000 units, you will be getting rupees 10. So as when you are accepting the proposal, the fixed overhead will increase by 35,000. So 1,20,000 plus 35,000 will give you 1,55,000. So now this 1,55,000 divided by 17,000, you will be getting 9.12. So now we have got the fixed cost. We will minus from the contribution to find out whether we have got profit or loss. So for 12,000 units, total contribution is 1,80,000 minus your fixed cost 1,20,000, which will give you 60,000, and the cost per unit for 12,000 units, contribution is 15 rupees minus fixed cost is 10. So where you've got 15 minus 10 as 5. So when you're producing 17,000 units, so contribution 2,15,200 minus the fixed cost, which is 1,55,000, you will get 60,200, and the cost per unit, the total contribution is 12.66 minus variable minus fixed cost per unit is 9.12, which where you will be getting 3.54. So now here if you look into it, 12,000 for 12,000 units you're getting profit of 60,000 with the cost per unit as rupees 5. When 17,000 is produced, the profit what you're getting is 60,200, and the cost per unit is 3.54. So the profit when you're producing 17,000 units is more by rupees 200. So what suggestion was given here is variable cost amount will be fluctuating, but cost per unit remains constant. Yes. So if you look into the problem, variable cost, the total cost are fluctuating, but the cost per unit for the calculation will remain same unless and until any adjustments are given. But when you look into the fixed cost, the cost per unit will the cost per unit the fixed cost will remain amount will remain constant, but the cost per unit fluctuates. So if you look into here, fixed cost is rupees 10. So as it is stated that it is increased by 35,000, the amount has been changed. So that is what they said, fixed cost amount will remain constant. So this amount will remain constant, but as the amount of units are increased, the cost per unit will fluctuate. So it is a vice versa explanation where variable cost amount will be fluctuating, but cost per unit remains constant. Fixed cost amount will remain constant, but cost per unit fluctuates. Though there is little increase of profit, that is rupees, so it is rupees 200. So as there is little increase in the cost per unit of rupees 200, it is by rupees 200 it is increased, that is from 60,000 to 60,200. So the 200 difference by accepting this offer, but it is advisable to accept the order in anticipating of getting more orders in future. So this is only the initial orders which has been got. So the management can decide the whether to accept the offers or no by looking into the data or cost sheets, by accepting future orders as well. So as future orders may be more helpful, because the initial order has given an increase of rupees 200, there might be chances of getting more profit in the future orders. So it is advisable to accept the order in anticipation of getting more orders in future. So thank you everyone. The other problems will be discussed in your upcoming videos.